Our mission really is to cut through some of the complexity around raising venture capital for new companies. We want to explore not just what it is, but maybe more importantly, if it actually aligns with your vision for growing a business.
Yeah, and let's get one thing straight right away. Venture capital, it's not just a loan. It's fundamentally about an investor buying a part of your company, equity. But, it's often more complex than just that. You might see things like anti-dilution clauses,
Mhm.
liquidation preferences, things investors use to protect their investment. They're really hunting for that, like 10x return. So they need businesses with absolutely massive growth potential, businesses that can scale up really fast. And the goal, usually a big sale or maybe an IPO, typically within, say, 5 to 10 years.
Okay, so it's a serious partnership, and there's some very specific expectations baked in, high expectations for growth. You mentioned that pursuit of like exponential revenue without costs growing just as fast. That sounds like the
Right.
dream, right? But getting there involves trade-offs, which brings us to this idea of a scalable business. We hear that term all the time. But what really makes a business scalable? Is it just about growing bigger, or are there specific things, maybe financial metrics, VCs are zeroing in on?
Right.
Hey there! Want to stay updated on funding info every single day? Subscribe to this YouTube channel. We've got tips, tricks, and insights that you won't want to miss. Get the knowledge you need to secure your funding, join our community, and empower your financial journey. Hit that subscribe button now.
Well, a scalable business fundamentally means you can significantly increase revenue without a proportional increase in costs. Think near zero marginal costs. Software is the classic example, right? Or platform businesses. Adding the millionth user costs way, way less than acquiring the first 1,000. VCs look for models where revenue just accelerates way past costs. Maybe you've got network effects or some proprietary tech that creates a moat. It's growth that actually makes your unit economics better over time.
Okay, that makes sense. Better unit economics with scale.
Hey there! Want to stay updated on funding info every single day? Subscribe to this YouTube channel. We've got tips, tricks, and insights that you won't want to miss. Get the knowledge you need to secure your funding, join our community, and empower your financial journey. Hit that subscribe button now.
And tied right into that explosive growth and needing VC money is this phrase, giving up some control. That sounds, well, pretty huge for a founder. What does that actually mean in practice, like in the day-to-day or in the boardroom? Are we talking about losing control over operations, or is it more about the big picture, the strategy, the exit?
That's a key question you have to ask yourself. Are you prepared to sell off a big chunk of your company? And crucially, are you ready to let investors have a real say in major decisions? Because VCs aren't passive investors. They aren't just writing a check. They'll typically want a board seat. They'll influence strategy, who you hire for key roles, definitely the exit timing and strategy. They might push for a sale when you'd rather wait, or focus on grabbing market share even if it hurts profits short term. I mean, their success is tied to yours, so they absolutely want input on how you get to that big payday.
Wow, okay. It sounds like a very deep commitment, not just a financial transaction. So let's say a founder is ready for that. They understand the trade-offs. They want that kind of partnership. What's the first practical step? How do they actually present their vision? What do they need to show these investors?
You need to make them believe your business isn't just a good idea, but that it's, well, almost inevitable. This usually means crafting a really compelling story. The main tools are your pitch deck, which needs to be concise, visual, data-driven, and a solid business plan backing it up. These aren't just documents. They need to scream, here's our unique value, here's our amazing team, here's our clear path to making money, and here's why no one else can easily copy us.
Hey there! Want to stay updated on funding info every single day? Subscribe to this YouTube channel. We've got tips, tricks, and insights that you won't want to miss. Get the knowledge you need to secure your funding, join our community, and empower your financial journey. Hit that subscribe button now.
You have to demonstrate the market is huge and that your financial model for achieving that rapid, efficient growth is credible. Make them want to know more.
Right. So let's bring this back to you, the listener. What's the takeaway here? Venture capital can pour rocket fuel on your growth plans. Big money for new products, reaching more customers, faster scaling. But, and it's a big but, the price is selling a piece of your company and sharing control over those really important strategic directions.
Exactly. So if your absolute goal is massive, fast expansion, and you're okay with sharing ownership and the steering wheel, then VC could be incredibly powerful. But maybe you're building a smaller business or a lifestyle business. Maybe keeping full control or growing slowly and steadily is more important. In that case, other routes like, angel investors, small business loans, even bootstrapping with savings might fit much better. So the question for you becomes, how does really understanding these trade-offs shape your vision for your own business?
And maybe one last thought to leave you with. For those companies that do go down the VC path, what does it really take to build that truly scalable business? The kind where costs barely budge as revenue explodes. And thinking personally for you, what would be the absolute hardest part about giving up some control of your own creation, even if it meant achieving massive success? Something to think about.